for joining us, Robert.
Thank you, Cynthia. Welcome, everybody. How to be eligible for substantial tax savings as a trader. That's today's topic. Think of a trading business like a house. It's where you want to live. There's a lot of shelter benefits. It all starts with a concrete foundation of trader tax status. And that's a term that I coined. That's the business treatment. You can't build a house without a concrete foundation of trader tax status. You can have a company, an LLC or an S Corp, but it won't deliver any tax savings without that concrete foundation. It will come tumbling down. So the first floor of the house is a simple sole proprietorship. If you qualify, you can claim that you can be a sole proprietor. It's not that big a deal. But if you want a two-story house, a McMansion with additional benefits like retirement and health, then you need the S Corp. And you don't want to build that more expensive house, a bigger house, more riding on it without a concrete foundation of trader tax status. It will come tumbling down if the IRS blows wind at it. Now think of TTS's business expenses, gives you the right to 475 election. That's fire insurance for your house. If that house burns down, you want a check from Uncle Sam. That's section 475. So we're going to go through how to qualify for all these benefits. And then we're going to talk about what the benefits are. So today's information is educational. When you need specific advice, which you do in this area, you're going to see there's a lot of nuances with trader tax status. There are golden rules, there are do's, there are don'ts. A lot of judgment comes into play. So where you need specific advice, you want to get it from a qualified tax advisor. I spend my days doing consultations on trader tax status. Should you elect 475? Do you want an entity? Which type of entity? Is it needed or not? What are the costs, the benefits? Now, we are not affiliated with Interactive Brokers. We do monthly webinars where they host them. We have a similar type of clientele, the active trader, the business trader, but we're not affiliated. And there's an IRS Circular 230 notice. You can read that as well when you download the slides later. So I'm the CEO of GreenTraderTax.com, our publishing company, and managing member of Green, Neuschwander, and Manning LLC, our CPA firm that just does trader tax services. We focus on it. It's so specialized, so nuanced, that if we were to try to be an expert at everything else, we could never be an expert at this. And this is why your local accountant may struggle with this information in law and decision making, because they just don't do the work in this area. It's very unique. So the first thing we're going to do today is do a deep dive on our golden rules in detail on how to be eligible for. So you're going to look back this year and see if you've been eligible for, and then you can simply claim it. Sort of like undergraduate degree in college. You're admitted yourself to college. You're going to claim your own degree on the honor system. You may want to go to grad school, 475. You may want to build an S Corp house with health and retirement benefits. That's going forward, but you can claim this for the past. This is the concrete foundation, how to become eligible. Now, as part of that, we're going to talk today about automated trading systems, because, you know, if you just go out and as an executive and you go on a website that features ATS, automated trading systems, and you license one, and you don't know anything about trading, you just license the ATS, hook it up with IB or another broker with API scripting, and just let the thing trade 24/7, and you really put very little work into it, you didn't create it, you're not going to get credit for those trades on TTS. But there are cases where if you write your own code, you do get credit. Similarly, with a trade copying software, if you don't depart from the system and you don't cherry pick and you just let that system put up the trades for you that you copy, the IRS may think you're not eligible to claim being in the business of trading. So trader tax status means it's a business, that you're running the business, you know the business. You're not just sitting back and letting everyone else do the work for you. Now, in other businesses, there's more leeway. You can be the brainchild of a restaurant and hire a chef and spend very little time and spend your day trading and not know much about the restaurant business. You may not do it very well, but you could do it. It's different with trading. I want you to be the pilot in the cockpit using the manual and automated controls. You can't be the passenger. Now, this stuff, folks, is not that clear with the IRS. There's not statutory law. It doesn't say in the law, this is a trader, you need X trades, X frequency, X this, X, Y, that. There's only one bright line test that came out of a court case, which is the holding period requirement of the average holding period of 31 days. So these golden rules that we're going to talk about today are based on our experience working with traders. We've been doing the trader tax status work since 1997, when Congress changed the law in Section 475 to allow traders to use ordinary gain or loss treatment, formally recognizing traders. Now, we've been working with traders going well back before that. So we have experience in using TTS on thousands of tax returns every year for decades and decades. And we've had extremely few IRS exams, and we've won exams because we follow these golden rules, and they are subject to change if we feel the IRS has some new cases that tighten the golden rules. We'll tighten, we'll loosen. We try to be conservative, and we try to give you a roadmap that you can say, well, I do qualify, I don't. Because, you know, if you look at case law, it just says regular, frequent, and continuous. That means a lot of things to a lot of people. So now, once we finish the deep dive on the trader tax status, so yes, you're in the business, no, you're not in the business. Once we finish that, then we're going to talk about all the benefits that flow. The linchpin is TTS, and then everything flows from after that. And a lot of things require you to make a move, an election, entity, a move, and you want to know what moves to make. And we're going to go over that, because the bottom line is, if you do this right, you might have 15, 20,000 of expense deductions, whereas as an investor, you get nothing. You might have a health insurance deduction of 12,000 or 24,000. You may have a retirement plan deduction of 57,000. You may be exempt from wash sales if you have losses. You're not stuck with a capital loss limitation. Write off a $500,000 loss against your wages, your spouse's wages. Get an NOL carry back. So you're talking about deductions that could go up to $100,000. You're talking about tax loss insurance in the hundreds of thousands of dollars. You're talking about a QBI, qualified business income deduction on 475 income of 20,000. Make 500,000, write off 100,000. Although you're not going to do it on that, because then you're priced out of it. So it's more like you make 100 and you could write off 20. That benefit prices out if you make too much. You learn what to trade to get lower tax rates, like futures. There's serious money here, folks. This is, people who trade are interested in this type of savings. We're not talking about $1,000 of savings. We're talking about tens of thousands of dollars of savings. And I think it's worthwhile. Now, it's not just about tax savings. It's about how the heck do you file a tax return with all these wash sales and 1099-Bs, which are different from IRS rules to taxpayers, and wash sale adjustments. And what's a security? What's 1256? People are very confused. So if you're a trader, if you've decided that you're going to open up an active trading account and be active in trade, you got a lot of responsibility. It's not like just getting a W-2 or a 1099-B, interest from a bank with a one line item, you TurboTax, you do your tax return. You have more responsibility. A lot of traders come from engineering backgrounds. They're the type that love all the detail. And I'm pretty impressed on how much they get into the taxes. So again, with TTS, you're going to deduct business expenses, startup costs, home office. With the S-Corp, health insurance and retirement, you'll get into the 475 for the exemption from wash sales, the capital loss, exemption from the capital loss limitation, the QBI deduction. So now let's do the deep dive. All right, this is really the main event for today. A lot of this content is excerpted from Green's 2020 Trader Tax Guide, but of course, as you know, I go off script, add color to it, which is original and new and fresh. So we're always looking at the tax court cases. It's amazing to me how far behind they are, because remember, someone's got to get audited, usually within a year or 3 years from the date they file the return. Then they dance the dance with an IRS agent for months and months and could delay it for a year. Then if the IRS agent proves difficult, doesn't know TTS, brings in a financial products expert and who wants to be obstinate and wants to quote some cases that are not favorable, and you get in touch with us even if we didn't prepare your return, but you used our golden rules. We agree to disagree with the agent in California. We transfer the case to our local office where we have a good working relationship with IRS agents who are educated on trader tax, who respect our credibility on the issue. And then we go through appeals and then hopefully win. And then lastly, it's tax court, and then that takes a great delay. And so you're talking about years, and 5 years later. So you're going to read about cases from 2017, 2016. So a recent case, is 2015 Pope Court. Now Pope, he tried to pull one over on the IRS. A lot of tax court cases, you'd be amazed at the boldness of taxpayers to try to cheat the IRS, argue pro se on their own, which can mess things up for everyone else because they easily get busted and lose, well, then they capitulate when they shouldn't. So Pope, he didn't do that well on tax court, but he did well. He did have trader tax status. And I think his numbers are a good golden rule for volume. And he had 720 trades, 60 a month, and the court was really focused on wanting to see 60 a month. We break it down further to the day and weekly case amount. So we recommend an average of 4 buys and sells per day, open and closes per day. So one round trip, a buy and a sell, if you're doing a day trade, that's 2 total trades. So we're looking for 4 per day, 4 days a week. That comes out to 16 a week, a little bit more than 60 a month, but then we'll trim it back down to 60 a month, 720 a year. So let's say you got started, which was a lot of people this year, the markets were really high, January, February, hitting new highs. We had a COVID crash. A lot of people, a lot of young people, they saw it as a buying opportunity. They didn't think it was catching the falling knife. They got in. They had their new accounts and they got in, burnishing to go. And they were bullish and they were well received. So it starts when you start. It doesn't start for them in January, February. It starts for them. Now, did they ramp up? Maybe you started with 1 trade a day or 2 trades a day in March and April, but by early May, you were up to 5 to 10 per day. And then you had a nice history of that from early May until now. Do you have TTS? Well, TTS is like putting bread in the oven. You can peek in the oven, you can even open the oven, maybe you shouldn't, but you turn the light on to see if the bread is rising, if it's rising. If not, it's not going to have TTS. So it's a little too early to tell if you have TTS. You're on pace for it maybe since early May, but you got to keep it up for several more months. Do you have to go through year end? Maybe, maybe not. These are the nuances. So you want to hit the 60 a month. So let's say you had April was 60, but May was 40. And you had several months under 60, and we don't think you have it. You have to look at a series of months back to back by hitting the 60. Now you're going to count each open and closing trade separately, not the round trips. Now some traders scale in and scale out of trades. They want to build a position of 1,000 shares, and then they want to sell piecemeal. They want to build in, scale out. If you're not just hitting a button on the computer, bing, 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 if like you have a little time in between the trades, you can count them separately. Now let's look at an example calculation of volume and frequency. The security markets are open approximately 250 days a year. But let's account for some personal days and holidays, and you can have vacations just like any other job, and figure the available days the market is open is 240. Now you may figure, hey Bob, I didn't have 240 days. This is if you were in that whole year. I only had 230 or 220 days I could have traded. So you want to make sure that your denominator on the TTS calculation is in your interest. Don't let the IRS hit you with a high denominator where your denominator is lower. So we're looking for 75% frequency on a trade execution. Now you could be working every day in the market, but I'm looking for the actual days you pulled the trigger on a trade and it got executed, not an unexecuted trade. Our golden rule looks for 75%. So if the markets are open 240 days that you can trade, and you have 75% frequency, that's 180 days per year. So if the Pope Court says 720 trades divided by 180 is 4 trades a day. So I'm looking for 3 to 4 trades a day, 4 to 5 days a week. So you get that 15 to 16 a week, close to 4 days a week. So back on the volume of trades on what counts. Now, by the way, we're on the big three first, the big 3 factors: volume, frequency, and holding period. They're the big 3 factors because the IRS can prove them out. By looking at your brokerage statements and your 1099-B, the IRS can figure out, an agent can actually do these calculations to figure out number of volume of trades. Now, they may not see that it's an ATS system or that the broker broke down lots, so they don't see it all, but they can see a lot of it. Now, by the way, why are we focused so much on the proof in the pudding? Why is it that the IRS really holds you to bear on number of transactions? They don't do that in other businesses. Why are they doing that? Because Mr. Pioli, he told the IRS he was a trader, that he worked every day at it. And he went to tax court over it. He was so insistent. And the judge said, Mr. Pioli, excuse me, sir, but you only had 3 trades in December. Where is it that you say you're a trader all year? So they said Pioli was a liar. He wasn't really trading every day. Looking at the markets is not good enough. And they held him to bear at this secondary requirement. So it's kind of a fallback requirement that has worked its way over the years to be the primary requirement. So we're focused on, you got to get through the big 3 before you go further: volume, frequency, holding period. So if you initiate a trade order and the broker breaks down the lot sizes without your involvement, it's wise to not count those extra volume of trades. I saw that in the crypto space early on. I mean, someone would have 100 trade executions for one trade. It was ridiculous. So options traders, they have, if you're doing complex trades in options, you have multi-legged positions. You might have a 4-leg position. Now, if you put on each leg separately, which is not usually the case, then I think you could count each leg separately. But a lot of times traders explain to me that the broker, they'll put in a complex options trade order and the broker will put on the spread for them. Now, if they have a 4-legged position, the broker might put on 2 and you might put on 2 and 2. And so you might be able to count 2 trades rather than 1, but maybe not 4. So we're finding that these days most clients tell us, no, the broker breaks it down for me. Now, I'm not an options trading expert. I'm not a trader. I focus on tax all day long. To be a trader, you got to really focus on it, especially to be successful. So trade executions count, not unexecuted trades. Think of the options trader. They say, Bob, I'm making a fortune. I'm full-time. I deserve all these benefits. How is it that the day trader in stocks who loses his shirt gets all these benefits and I don't? I put on an options trade on Monday on a weekly, and I get out on a Friday. I might tweak it on a Monday, on a Tuesday or Wednesday, but I have Monday and Friday for execution. That's 2 days a week. You're telling me I don't qualify because I don't have 75% frequency? And I say something, you know something? What about the hotel analogy? Maybe we can go to tax court with that and say to the IRS, listen, in a hotel, the business traveler checks in on the front desk on Monday, checks out on Saturday or Friday, is in the hotel 5 or 6 days a week. The room is serviced 5 to 6 days a week. The hotel has to take care and make the bed 5 to 6 days a week. So what if you only dealt with the front desk 2 days a week? You had to monitor, tweak that trade during the week. I'm anxious to go to tax court, to go for continuous business activity, which is in the tax law, but that hasn't hit the court yet. Do you want to be the guinea pig that does that? If you do, okay, come to us. We'll try it. But I usually talk people out of it because they don't want to be the guinea pig that goes to tax court. So unfortunately, in those option cases, there's a lot of unexecuted trades. They don't count. I think they should, but they don't count. So we're back to these big three as being the main event when continuous business activity should really be the main event, but Paoli messed it up for us in tax court. A lot of tax court cases are people are hurting us as a community because they're not coming to someone like us to fight for them to win it right. And then it sets precedent. And then we have to unwind it and how it's not really, unpack it, it's not really precedent. So now we're up to frequency of trades. Remember, we're doing a deep dive today, folks. So we've got 90 minutes. We're running a little late. You can go back and get the recording later. I want you to have all the color because it comes down to the color. It comes down to the deep dive. It could be the difference of yes or no. Are you ready to build a McMansion S Corp? Go for all the benefits on TTS if you're a close call and fail? Not smart. You want to be conservative. Let me be the umpire to call the balls and strikes on you. If you strike out, sit down. There's another day to get up to the plate. Don't swing for the fences and think you got a home run when you don't. It's IRS trouble. So frequency, executes trades on close to 4 days a week, around 75% frequency rate. The tax court requires regular, frequent, and continuous. What? Time? Trades, frequency, holding. I mean, it's not, there's a lot of unanswered questions there. If you enter or exit a trading business during the year, then you want to make sure you maintain the frequency rate during the TTS period. Now, I'm very concerned this year about the COVID-19 impact, that people were bounced out of their job, furloughed, fired, put on leave, working remotely from home, able to trade, needing to make money for their family, seeing great success in the markets, jumping in with fear of missing out, doing great so far. And I think that's wonderful. I'm not trying to discount that in any way. I'm not trying to say if you're young and have made $1 million that it won't continue. I'm not trying to disrespect anybody's success or undermine it. I'm just saying, are you going to continue when the going is good, when the going is tough? Are you really, are you going to go back to your job, even if it's remote, and stop trading after some losses? If you do, the IRS may not think it's a long enough period, like the Chen case. So I want to see frequency of trades and consistency over time. That's the word continuous in the regular, frequent, and continuous. So time off from the execution of trades should be a reasonable amount of vacation time, other non-working days. It shouldn't be hot, cold, you got the restaurant open, you close it, open, close. Now, restaurants are doing that because of the law, but and they're going to still be in business. But again, remember, the trader is, the IRS is prejudiced against the trader. They think you're an investor. They don't want to open the floodgates of all these benefits to those 20 million, 10 million, whatever they are, number of online accounts, which have proliferated this year. The numbers are incredible. Look at the cover story of Barron's this week and recent articles about it. And I can judge from our business. The proliferation of trading is gangbusters. You know, zero commissions, volatility, big moves, and just the way the modern economy works with social media and everything else and automation. So think of TTS like a job. Only the markets are your boss. You got to work every day, and you got to show the cash, show the IRS a punch card that you're working every day. Save some of those sessions. So in the following cases, Helsinger, Sadaragi, Endicott, Nelson, they traded 2 to 3 days a week. They were really investors. They had a FANG portfolio of buy and hold. And they with a portfolio, like a lot of people with a portfolio, they say, I got to manage risk with options. Collect premium, manage risk on, risk off. I want the TTS from trading and all the benefits of that on the options, but I want to keep the deferral of capital gains and long-term capital gains on the FANG stocks, on the holdings. I want the best of both worlds. But, if you don't segregate things properly and separate, the IRS views it all together. And so all their holding periods were too long because they got pinned down with their investments. They should have segregated, ring-fenced with an entity. And they were doing portfolio margining and other issues that come up later in this webinar with ring-fencing. So they only traded 2 to 3 days a week. So if 60% is not good, I think 75% is good. There's a little cushion in this one, but that's our job, is to provide cushion where we think cushion is warranted. So if your frequency is 70%, it's not a bright line test. That might be okay. Holding period is a bright line test. This is the most important factor. And those court cases I just mentioned all had holding periods when you factored in their investments, which they didn't ring fence, and they traded around, so they had a factor. They got stretched out to 45 days, 60, 90 days, and it was, the court said, in Endicott, the court said it must be 31 days on average. So it's an average. It's not that you can't have some positions over 31 days. It's the average. Now, it's more natural for a day trader and a swing trader or a combination of those to meet the holding period requirement. So you want to segregate your investment positions into a separate account, maybe not trade around those positions. You want to segregate in form, which is a separate account, or the ring fence trading in an entity. You want to separate in form and substance. So even if it's a separate account, but you keep trading around those positions, you can drag them into the TTS holding period analysis. So if you're a monthly options trader, you face challenges. Your holding period may be over a month. I find that a lot of options traders now also have a combination of weeklies. And yes, they may enter a trade 35, 40, 45 days out, but they close those trades after 1, 2, or 3 weeks. So Holsinger was an options trader, and he was too long. So consider the following example. You're day trading 80% of the time. If you look at all the trades that you make, the 80 trades you made in a month, which was over the 60 requirement, 80% of those trades were day trades, 20% were options trades that were 35 days. Well, the average is under 31 days, so you're good to go. Now, it hasn't come up in tax court whether we have to use weighted average. Now, we tried to make an app to help with all these things, but the app vendor failed us, and it didn't really work out. So that's something that we might do down the road, but it still will require a lot of judgment. So you want to try to get your hands on these numbers and then analyze them according to our golden rules. So, carve out a week or two that you feel is representative and see what that looks like. So sample. You don't have to do every day of accounting. You want to just do samples. Now, you can trade full-time or part-time. And the IRS more scrutinizes the part-time trader. Now, you're an individual, you're a physician, you have TTS, you make $500,000 a year as a physician, you claim TTS with a Schedule C and deduct a lot of expenses, more than normal. You elect 475 and write off $500,000 again this year without the EBL limitation with the CARES Act. You write that off against your physician income. And the IRS looks at your 1099-B and sees 100 trades. You're begging for a beatdown. You didn't qualify. You took advantage of every little benefit possible. It was on an individual return, money losing part-time. You're a physician. The bar is raised. You shouldn't have done it. If you worked with us, we would have said, no, you didn't have the TTS. If you did, you absolutely should have done it. We would have explained it and fought to the end to win it. But you got to hit the numbers, but put it into perspective. If you're a full-time trader, if you have an entity, or if you're part-time and have an entity, it looks better. If you have gains, it looks better. So it doesn't change the golden rules. It just changes the context a little bit. So a full-time options trader actively trading significant portfolios may not qualify, whereas the part-time day trader might. Is it good public policy? No, but you got to navigate the landscape of the law. Unfortunately, the IRS is pinning us down on just a numbers game. You want to play a numbers game? Okay, we'll play the numbers game in our favor. Time spent. You're not punching a clock. But you don't necessarily do that in remote working anymore either. America's starting to realize that you don't need everybody in the office to look over their shoulder. Look at the performance. Look at, the files of work, the work put in. So I find that traders spend a lot of time. It's not just trade hours. It's execution of trade orders, yes. It's research, administration, accounting, education, travel, meetings, back testing your automated trading system, working with professionals. There's a lot of time that we're watching the news. So if you wake up to trade the morning session on the West Coast and get the good, nice, solid morning session in and check things at lunch and do a lot of research and administration and putting on trades at night, you're hitting the numbers easily on 4 trades a day. I'm surprised how many people tell me I spend 5 to 6, 7, 8 hours a day when we're only looking for 4 in the golden rules. And they have a full-time job, or they have another full-time business. People juggle a lot. What else is there to do with COVID? But again, this has to stand up to life after COVID. And a lot of people pre-COVID. So a lot of part-time traders spend more than 4 hours a day. Now, trading is not a passive loss activity. If you've been a real estate investor, or you've invested in the old-fashioned type of tax shelters, or you get K1s, and you're a limited partner, so you don't it's a passive loss activity. You're familiar with this. You know that you can't deduct your loss. Great, it's real estate. It kicked off a loss of depreciation, but you can't deduct it. It's a passive activity loss. But if your material time spent and you're active, it might be a loss you can take. So some traders feel that, am I going to get stuck with the passive loss activity, the hobby loss rules? No, neither of those apply. So if passive loss doesn't apply, then the material participation rule, generally of 500 hours per year, doesn't apply either. But again, I think traders easily surpass that anyway. So under the trading rule of the passive activity loss rule, doesn't apply. And the reason they do that is they don't want you to have a real estate K1 limitation on one hand and bail it out with a hedge fund K1 on the other. So if an agent brings up, hey, do you have material participation? You say, excuse me, sir or ma'am, you're off on the wrong foot. It doesn't apply. Now, let's say you got it. You hit the numbers on TTS. You're good to go. But you're not continuous. You have sporadic lapses. You just don't want to have too many of those. The IRS has bounced those cases. Now, you can have your vacations, your sick time, your personal time off. Some of that you can explain on the trader tax return. You want to explain them in the footnotes, just like you want to explain, here's the trader tax law, Here are the Green's golden rules. Here's how we qualify for each one of those. You want to lay that out in the tax return so that you're telling the IRS, got any questions? Here are the answers. Nip the questions in the bud. You want to lay it out, including on the sporadic lapses. Now, we've seen traders hit a rough patch on crypto. Okay, now they're going to go into options. They want to retool. Hit a rough patch in options. Now I'm going to retool for futures. Go back to trading school. Go back to paper trading, or have a medical problem, or a family problem, or a COVID problem. Is the IRS going to accept those excuses? Maybe, maybe not. It's going to really help what happens subsequently. Mr. Chen, who argued his case in tax court, he was an IT job. He traded for 3 months one year, January to March, lost a fortune. He lied to the IRS about electing 475. He never elected 475. They busted him over it. Once he realized he was busted and he couldn't deduct his huge losses with 475, he capitulated on trader tax status because he only had 5,000 expenses, not many expenses. So he figured, I'm not gonna, and he would have qualified for just 3 months. And I could have maybe won the case for him, because I think that in America, a lot of businesses open and shut in 3 months. And why should the trading business too? But Mr. Chen argued his own case, capitulated when he shouldn't, and kind of set the table, hurting a lot of traders going forward if other agents use that as precedent. So think carefully about the time off that could undermine the TTS with the sporadic lapses. And this is the comments about the Chen case. So it's not clear if the IRS will respect that as a valid interruption if someone takes off for health reasons, and like COVID as well. Now, let's talk about intention to run a business. Intention is your motivation. It's what's in your heart and your mind. It's hard to prove this out on paper. And this is a nuanced question, but it's got profound implications. So in a consultation, I ask you about this. I don't coach you to the answer, but I do explain the nuances in the context. But it's got major impact. If you don't have the intention to run a business, it trumps all the other factors, and you don't have TTS. So traders must have the intention to run a trading business, trading your own funds. You're not talking about trading investor capital. Now, here's where a lot of people get tripped up, and the IRS fools a lot of people with content on their website, which is not official and wrong, and I've confirmed. Even when Barron's did it, or Wall Street Journal quoted me recently, and I really gave them a lot of information for the whole story on TTS. The writer put in primary, and I asked him many times to take it out, but he left it in. I guess the editors preferred it. It doesn't have to be your primary means of making a living. Think about all the billionaires in this country. They have 10, 20, 30, 40, 50 businesses. Do they get business deductions because it's only the primary? Doesn't have to be primary. The key word is a living, a primary or supplemental living. Now, many traders enter an active trading business while still working a full-time job. With advances in technology and flexible job schedules, working remotely, it's possible to carry on both activities simultaneously. A lot of traders have a trading business, a remote job, and another e-commerce business that they're doing through Etsy or Amazon or whatever. Or they're winding down another business. Now, many traders are home from their day jobs with COVID-19 and carry on a trading business now. But will that continue? What's your intention? Now, I don't think it's a good idea to combine a TTS, a trading business, with another business where you were a computer consultant, you're winding that down, or you were some sort of, a restaurant or an auto dealership, and with COVID, you're winding that down. And you're doing great trading, and you aspire to be a full-time trader. It's amazing how many people aspire to it, because for some people, it's like a dream come true. You sit at home, you trade, it's exciting. and they do really well. I can tell you from years of experience, a lot of people also lose a lot of money and go through a lot of pain. So it's not all roses and gold. There's also problems, full disclosure. So, but a lot of people aspire to a full-time business. Don't just retool your auto dealership into a trading business. Don't say, I'm going to use my treasury capital, take a distribution, set up your own trading house. Don't merge trading into your other business house. It will confuse the IRS on what are you doing. It undermines trader tax status. It could call for reasonable compensation where it would not be due because trading doesn't call for reasonable compensation. Will mess up the IRS on QBI analysis on what's a qualified business income deduction. So it's so simple to set up a new trading house and do that instead of using your existing entity. Now, an entity does look better than a sole proprietorship Schedule C. So I'm going to show you how to claim the Schedule C year-to-date and for last year, 2019, if you hit the numbers, all a part of the year. And that's great. And maybe that's good to go forward with as well. But also you might be better off with a new entity that looks better, gets you into a QBI deduction late in the year. So we have to decide what's better for you, an entity which looks better or a sole proprietorship. We're going to take into account cost, benefit, everything else, convenience, whatever's in your best interest. Now, trading is not a hobby loss. If you get audited by the IRS and you look at the letter that you get and you say, wait a second, this is a hobby, well, you give it to your accountant, your accountant says, wait a second, this is a hobby loss letter. This is a series of questions that the IRS pulled off of a computer program to see if I have a hobby loss, because I've been losing money many years in a row, and they seem to want to hold me to a profit standard and 2 out of 7 or 3 out of 5 years, and they're setting me up for a hobby loss denial. Let me talk to Green and nip this in the bud, because, and this came from several years ago when an agent tried to pull that on a client of ours that had perennial trading losses. It's amazing to me how many years in a row someone will have losses before they stop. But we say, wait a second, it's not a hobby loss because it's not recreational and personal in nature. A hobby loss business is the gentleman farmer, the horse racing, the horse breeding, the avocado farm. It's something, it's the golf teaching business. It's, you have a hobby that you love, but it's expensive. You figure, hey, if I try to make a little money from it, then I could write off this huge loss and game the system with the IRS. But the IRS has all these hobby loss rules to prevent that. But when you look at the law, the 2 out of 7 or 3 out of 5 year profit motive test is only when it's recreational or personal in nature. Trading is making or losing serious money. It's a business. Now, what gives me pause and concerns me this year, it always concerns me when a trader says to me, oh, this is my hobby, I love it. And I see that they're losing money and they're almost like addicted to it. And I'm thinking to myself, is this personal or recreational for this person? Or they say to me, I used to be a professional gambler in Las Vegas. They closed the casinos and I got into trading. A lot of traders in Nevada and Las Vegas. And this is my new business now. I was a professional gambler before, and now I'm a professional trader where I love it. Or think of those gamers who are now, have new online trading accounts that the media keeps talking about. We don't do gambling tax. People said to us, why don't you do it? It's similar, Bob. We won't touch it with a 10-foot pole because we're doing Main Street, Wall Street, professional trading. Money manager, hedge fund, this is serious business. We don't want the IRS going down this rabbit hole of recreational personal. So wipe that clean off your slate and be strong on that. So again, you may supplement your living, you may really like it, but it's not a hobby. And anyway, even, you know, if you have gains, you're not worried about passive loss activity or hobby anyway. So that's just to cover those issues. Now, traders have serious operations. They have significant business equipment, education, business services, a home office. Now, you know, you don't need a store. You don't need an outside office. You don't need employees. You don't need a license to trade your own money. You don't need a lot of equipment. You might want a powerful trading equipment. Now, I have found that the majority of traders have multiple computers. They have powerful trading desktop. They have laptop backups or laptops. They have multiple monitors. They may have 2, 3, 6 monitors, 8 monitors. You're going to have that many monitors. You have a serious desk and chair and some other ancillary equipment to go with it, and battery backup. You have various business services. You have the home office. You have the trappings of a business, of a trading business, of something serious. And you have the multiple monitors. You have the extra smart devices just for trading. And you have a lot of subscriptions, and maybe education, extra high-speed broadband and wireless and backup. You might have some staff. You want to put your best foot forward with the IRS. You want to deduct all those things, and you want to showcase them. It helps support your trading business. It's not, there are some traders that just have one laptop or just a phone. I've seen traders with just a phone, but that's more the outlier. You want to know, you want the IRS to respect your business operation. The home office is liberated. America has home offices. That's what people have in America. And it doesn't have to be your primary. It doesn't have to be where you meet clients. It's been liberated. You need income to get the deduction. That's how the IRS controls it. So a lot of traders have a dedicated space. It might be a cordoned off area of a room. I had one trader told me the other day he's in a hallway. He just bought a new house where I'm in a corner, or you know, you cordon off this area. You don't let the kids play with the monitors and the equipment. You can't afford to have anything messed up. So you don't let guests near the stuff. It's got to be exclusive use for the home office, but it can be an exclusive use area. And you want to take this deduction, including the depreciation, which is allowed or allowable, because it helps support your trader tax status. So read more about the home office deduction in our guide about how you need the exclusive use. Every indirect cost of your home, every indirect cost, no matter how personal, based on the square footage method, is going to be a deduction with the home office deduction. If you have trading gains, it unlocks the deduction. We show you how to do that in our guide. So it's one of the biggest deductions for traders. It's really nice to convert expenses that you have anyway into a business deduction. A lot of your other trading expenses, you're going out of pocket for that new trading computer, your new monitor. The QBI deduction, the home office, that doesn't require actual expenses. Those are kind of just expenses that come out of nowhere. Your account size should be material. So traders need to have $25,000 on deposit with a U.S.-based broker to achieve patent day trader status, PDT. With patent day trader status, you can have 4-to-1 intraday margin rather than 2-to-1 on a normal margin account. You can trade actively without PDT, but you might still qualify for TDS, but PDT traders, just because you have the right doesn't mean you have TTS. You got to still use the right. So it's still, you can qualify, but it's harder. Now, if you're not trading securities, you know, equities or equity options, you don't need PDT. You're not using that kind of leverage. It's more built-in nominal leverage. We like to see a $15,000 account size. So if you have $5,000 account size, it's not really cutting the mustard. Now, it's the materiality counts. I mean, if you're a millionaire, you probably need something a little bigger than that, especially if you have huge investments and then just carve out a little trading and then try to deduct expenses related to everything. You've got to use reasonableness on the allocation between investing and trading. But if you're unemployed and you don't have much capital, you're really young, just out of school trading, then I think you might be able to capitalize equipment startup costs and a little leeway on the $15,000. That's one of the golden rules that we picked out of a hat. That's not really even in the tax court cases. We just feel makes sense. And it's a good time to remind you that some of these rules are based on logic or common sense, and we've used for many, many years with the IRS with great success. So some of this stuff is us. Some of it is born out of IRS exams. Some of it is born out of case law, what other people think out there. So it's a combination thereof. Now that we went through what does qualify, let's talk about a few things that might not qualify, or they could qualify depending on your level of involvement in it. So one second, let me just drink something. Hopefully you're all still with me pretty good here. Again, you can listen to the recording later on to skip ahead to certain sections that you like. We're getting into automation now, and trade copying and outside advisors and retirement accounts. Does all that count? A lot of people are doing that as well. They have a outside account that's managed, through an automation that's very actively traded. Do they get TTS for that? They're trading in a retirement account. Does that qualify? They got an ATS system together, automated trading system. Does that, with 24/7, lots of trades, does that qualify? Does the trade copying software qualify? Good questions. 4 types of trading don't qualify. If you're using an ATS without much involvement, you didn't create it, you just went out there and got a canned system, flipped the switch on, and it's trading for you, you don't get TTS for that. In a similar vein, you got a trade copying software, serves up 5 trades a day. It's all automated. You just copy the trades. That's not automated, but you just press the button to copy the trades. You're a fly on some trader's wall. You copy the trades. You don't know anything about good or bad or anything about the trades. You didn't, if you lose a lot of money, you're going to say, hey, that was a bad system. I didn't do anything. It gave me bad advice. Now, these services may weasel their way out of, that's a poor word, let me retract that. They may argue their way out of giving investment management because they don't want to be registered. They're not registered investment advisors giving customized investment advice for compensation. They're just licensing you a system, and you're paying them based on performance. The broker says, I'm not responsible. You just set up some outside party for API scripting, licensed software. The ATS says, I'm not responsible. I'm just licensing you a system. It's up to you to use it or not. It's up to you to be responsible or not. So maybe they use the publisher's exemption or the financial newsletter's exemption to get out of liability for giving investment advice. But can you claim trader tax status for it? I don't think you can, unless you're significantly involved with it. In a similar vein, and this is where I draw this logic from, this hasn't come up in tax court, this is my logic. You draw it from the investment advisor, got the outside manager, they day trade, they swing trade. You don't have TTS, that's an outside managed account. That's pretty clear in the tax law because there's a lot of case law where the broker had discretionary trading and the trader couldn't get credit because the broker made the trade, the outside manager made the trade. Well, if you automate that, then the same rule should apply. The automation you should not get credit for that. Now, if you build the automation, if you're building it all, it's different. So let's deep dive now about the ATS, TCS, and this other stuff. Why do I want to deep dive? Because this is coming up a lot more and more. A lot of people are getting into automation, which is good because Wall Street got into automation, computerized trading. And then they said, oh, 70% is retail. And it was the Main Street trader who was left out having to fight against the robots. And who, the HFT, well, now the level is being democratized and the playing field is being level again. And that's a good thing. And I'm all for automation. I'm not anti-automation. I'm all for automation, but if you're the passenger in the plane, how are you going to argue to the IRS that you're the pilot? I mean, we're not to the point now where it's self-driving planes. We still have pilots in there. We might have self-driving trucks and self-driving cars, but not yet. Well, we have drones, but they're small little planes. They're not, I don't want to get hung up on the metaphors and the analogies. So you get the concept of being the pilot. I think that that still works. I think that that's safe to use that concept. Should someone try to go for it, if it's outside ATS, maybe they could try, but the IRS gets a hold of it in an exam, I think they're going to lose. But let's see what tax court cases show years from now. Unfortunately, the IRS is so far behind it. They're so far behind even that the type of trading is going on. Almost everything we do, the IRS is behind. We need to fill the void for taxpayers who need to file tax returns, who can't just sit around waiting for statutory law and case law, because it's often lags, but especially when it comes to technology. So the IRS may view the outside developed ATS the same as a trader who uses a broker to buy, sell decisions, that someone else is responsible for the trade. Now, if you create the ATS, I think that that's good. This is where I'm meeting you halfway. I think if you make it, you can go for it. Because to make it, you got to really learn and know a lot about trading. The design, it's almost like you got to know how to manually trade, to then automate a system to automate what you do manually. Because you're going to go to your high-tech employer during the day in California, but you want your system trading 24/7 around the block, and you're okay with the algorithms and the black box and the programming. That's what you do for a living. You're a software engineer. So if the trader can show he's involved, she's involved, a lot of she's, computer programmers, with the creation of the ATS, perhaps by writing the code or algorithms, setting the entry and exit signals, and turning over only execution to the program, the IRS may count the ATS generated trades. Now, some traders don't have programming experience, but they have financial and trading experience. They're MBAs. They really know what they're doing with trading. They design the ATS. There are tools to do it, but they can't do the programming, so they hire an outside programmer who doesn't know beans about trading. And the programmer uses Python or whatever to make the program. You know, I think of that like you don't speak French, but you write your trading program, and then you hire a translator to convert it into the French language or the Chinese language so that someone else can use it, can do what you do. So they're just translating the language to a computer to understand the computer language. I had a client this past week who wanted to copyright the ATS. He wasn't the programmer. He was the financial executive, just what I said. He went to the copyright office, and the copyright office said, well, wait a second. You don't own this. The programmer does. And he said, no way. This programmer doesn't even know anything about these trades. It's all me. This is just a translator, just putting it into computer language. And the copyright office agreed with him and gave him the copyright. So think it out. And now, here are some other issues. It is helpful if the trader shows he spends more than 4 hours a day working this up. I mean, people who build their own ATS put a lot of work into it. It's maintenance, back testing, modifications, tweaking, a lot of paper trading before it goes live. And we, by the way, show you how to capitalize and write those off under Section 174 internal use software costs. Now, when I'm interviewing you on TTS and you say, Bob, I have 100 trades a day, not 4, 100, 5 days a week, and I have a demanding full-time job, I say, well, wait a second, are you doing manual trading or automation? Well, what do you mean by automation? I'm automating execution, but not entry and exit signals, or I'm automating it all. I ask how much time you spend a day. If you say I spend a half hour, it's kind of starting to sound to me like you got a canned system that you didn't buy and build with back testing and everything else. So I kind of pick up the clues, and the IRS will as well. So again, this has not come up in tax court yet. So self-creation of the ATS needs to be significant to count for TTS. Just making a few choices among options offered in an outside developed ATS does not qualify. I had a group of 4 guys this week. They all worked at big tech. They developed the ATS system. They put a lot of work into it. And they want to license it to other parties. And I said, well, wait a second. How much is the other party that your customer going to put into this on their own? Are they going to have it TTS, or are they going to be stuck as an investor, in which case they can't deduct what they pay you? There's no investment expense under the Tax Cuts and Jobs Act because it's a suspended investment expense. And they say, well, we give them a lot of options. I said, what options do you give them? Well, they're up front. They determine what asset class they want to be in, what risk level they want, and a few others. They say, well, wait a second, this sounds just like an outside managed account or a robotic trading account with Betterment or Wealth Lab or whatever, Wealthfront, where you just up front, they're telling you their risk level, their asset class, and this, that, and the other. That's not self-creation of the ATS. So now, if these guys use their own ATS in their own trading business, they have a business expense TTS because they built it. There's no doubt about that. So you got issues for the customer, issues for you, issues for regulatory. They're all a little different, but they all overlap as well. But you got to have significant input. And I have seen some building. I mean, this stuff, I always try to get a range. This is TTS, pure and simple. This is not. There's always a range in between. There are some building projects where you could buy pieces of code through open source. You can go out and not buy, you can just grab open source pieces of code. There are buy and build systems where a little bit of column A, column B, column C, where you could self-build, but is it enough? So I want to discuss it with me. I use common sense. You may disagree with me. Go on your own. That's fine. I try to be conservative about it, but yet also clever and unique about it as well. Don't just assume that the IRS won't be able to connect the dots on this. This could come up in tax court for you 5 years from now, where this proliferated, the IRS wrote law about it, and you just were on the wrong side of it. So if you're on the wrong side of TTS, okay, adjust your behavior accordingly. You know, don't go for the gusto with a TTS McMansion if you don't have a TTS concrete foundation. So there's other ways to go about doing your taxes. So again, the pilot analogy. Now, if traders spend, as far as once you determine whether so you're the customer, you get the ATS, you build the ATS. You want to write it off. You're not writing off your time. You didn't pay yourself anything. If you had some programmers, you're capitalizing what you paid them and writing that off. So it's one of the TTS expenses. Now let's talk about a trade copying software or service. It's a little different. Some traders use a trade copying software. That's the term that I came up with, or service. Trade copying is similar to using a canned ATS or outside advisor, where the copycat trader might not qualify for TTS on those trades. Here's an example. You sign up for a trade coaching service. You know, you're going to get education, mentor, they're going to show you how to trade. But they understand that you're a newbie, and what they're teaching you is highly complex. You know, stock index futures, you know, charts. I mean, when you see what traders do, IRS agents are blown away. They want to become traders themselves. It's a lot of stuff that goes into it. So they're coaching you, they're showing you education, but they understand that it's not easy. Some people come from other walks of life where this is all new to them. So they offer you in a trading platform, they say, pay this fee up front for the software and then pay this ongoing fee. We're going to show you what we're doing. We're going to show you how to apply our education specifically in the markets, live trading. We're going to serve you up 5 trading signals a day. We're going to say you should consider, or not you should, consider, we're not telling you what to do, these 5, 10, 15, maybe we'll start you off with 5. When you get more advanced, we'll give you 20 trades to make a day. We'll tell you the entry and exit signals, the stop losses. And, you know, I say, I'm interviewing you on TTS, and you said, hey, I just spent 5, 10, 15, 20, 25,000 with this trading school, and I got this software. And I'm trying to see if you got TTS so you could write off those expenses using with look back section 195 start. Of course, it's a big number to deduct. I want to see if you're going to qualify to deduct it. But I'm starting to get the drift of it and talking to you that you're not spending a lot of time. You're not really doing really anything. You're just copycatting what is served up to you. Is that going to be a problem? Maybe it is. If you're just going to do what they say and not depart and not put in much thought, are you really a trader? Now, if the trader follows the TTS very tightly and does not significantly depart from its suggestions, then an IRS agent might feel that he or she does not qualify for TTS. Now, on the other hand, if the trader cherry picks a minor percentage of the suggested trade, so they serve up 10 trades, you say, I'm not making those 10. I only like these 2. You know, and I don't want that stop loss order. I want a different stop loss order. I don't want to jump into the trade this second. I want to check it out a little bit more. I want to have a different entry, a different exit. I think that you significantly departed, and maybe you can get credit for those trades. Now, it would help if you're also doing a bunch of manual trades or ATS trades on your own too, and that you really are the pilot. You're not just, you know, a passenger invited into the cockpit to say, oh, see that button, hit that button. You see that button, hit that button, with some kid sitting on a pilot's lap. So use common sense on that. Now, some of the trading schools may not like my advice on that, but I have to call the balls and strikes the way I see them based on my years of experience and common sense. If you want to disagree and make a different case, then do so. Now, engaging a money manager, hiring a registered investment advisor, like an RA or a commodity trading advisor. So you engage your advisor, you give them a power of attorney to trade, you open up an account with an FCM, and they make all the trades, and you don't make any trades. You don't even know what they're doing. Well, obviously you don't have TTS. When you pay their advisory fee, whether it's a performance fee or a management fee, you can't deduct it, because it's an investment fee or expense which was suspended under the Tax Cuts and Jobs Act when they flattened the tax code to justify lower rates and roughly doubled the standard deduction. So that itemized deduction went out the window. And you can't claim TTS because you're not making the trade, so it's no business deductions. It's decades-old law on this. Now, what about, you say, well, Bob, you know, I'm not engaging an RA or a CTA. I'm going to set up an LLC, or I'm going to set up a trading business. I am a trader. I'm a sophisticated investor. I'm putting a lot of time into this, but I don't have the time all day long. I'm also running an auto dealership where I have my investments to code a bunch of stuff, to execute every trade I want. I'm going to have an assistant. They're going to work for me as an independent contractor or an employee. They're not a professional trading advisor. They're kind of new to it, actually. I'm the trader. I've established myself as a trader, but I'm hiring some assistants. Well, I think that's part of your TTS. That you can deduct as an expense. That's an inside person that you're really calling the main shots. You're the supervising them. You're the main trader. You would have TTS without them. So you can deduct what you pay them. Now, if you say, I'm going to be clever about it and set up an LLC with a CTA, that's going over the line, and I don't think you'd find a CTA would do that anyway, because then they would be a commodity pool operator and have to worry about that. So use common sense there. Now, let's look at the spousal brokerage account because it uses some of these concepts. You know, you're a married couple. A lot of traders are married. Their spouse may not be the trader. Their spouse may not be involved with administration and do anything other than, you know, use a joint account. Because if something happens to you, you want your spouse to be able to quickly liquidate the positions and have that be clear. So you have a spousal joint account. And look at this example here to crystallize what I was just telling you about, the titling of accounts on who's the trader, who's the investment manager, who's the investor. So with married couples, if spouse A has an individual brokerage account in his or her name only, and gives power of attorney to trade to spouse B to trade it, let's not use gender here, just spouse A, spouse B, the IRS won't grant trader tax status even if spouse B meets all the TTS. So spouse A has the account in their name. Spouse B does all the trading for spouse A. Spouse B is an investment manager, but not getting fees. Spouse A is an investor. Neither one of them have TTS. Because why? Spouse B is not deemed an owner of the account. With a hedge fund, the investment manager, who let's say has TTS, can bring it to the hedge fund level. When you have a trading company with your spouse, a spousal LLC partnership, a spousal LLC S Corp, the trader's spouse is bringing the TTS to the entity level as an owner. The trader has to be an owner on the account. So married couples can solve this problem by using a joint account. It's better if the trading spouse is listed first, but that's not an absolute requirement. So you want to do it on a joint account. You want to avoid the AB. Now, if you trade in a retirement account, which could be a prudent thing to do, building up tax-free money until retirement or permanently with a Roth, you can't count those trades as part of your TTS. So if you say, Bob, I have 3 trades a day, 4 days a week on my taxable account, but I got this other 2 on my retirement account, can I use the 5? No, you can only count the 3 on the taxable account. Now, trading in a retirement account could be nice to build it up, but TTS is not a concept, and you don't worry about 475 or any of those things. You have pure investment expenses, you can maybe get reimbursed for those out of the retirement account. If you arrange it, it's a little tricky to arrange. Now, if you're trading an IRA account side by side with a taxable account, be very careful. You might trigger a permanent wash sale loss. Sell Exxon in your taxable account, buy it back within 30 days in your IRA account. You can never deduct that loss. The 1099B doesn't pick it up, but you're supposed to pick that up. So you can fix that with a 475 election or do not trade list. All right, now, that's it on the deep dive. We went long on that. So now I'm just going to drink something, take a break for like 15 seconds. Now we're going to talk about, you made it to the finish line, you have TTS. Let's make it worth your while. What are you going to get out of it? What are all the benefits? I'm going to quickly show you those. I've showed you that in prior webinars in detail. I've showed you how to set up the trading business, the Schedule C, sole proprietor, the LLC partnership, ring fencing, the S Corp, employee benefits. I've showed you all that in detail in the past. You can always refer back to that. But I didn't want today's session to go without just a quick synopsis of those benefits again, to make it worthwhile for all the time you put into following me so far, for those who are new to this. So one second. Boy, do I talk a lot. So you made it for 2019. You said, Bob, I started this in July 2019, and I'm still doing it. Great. You can add a Schedule C for June 1st to, well, let's say started July 1st to the end of the year 2018. You can go back and capitalize startup costs to January 1st. You still haven't filed your 2019 tax return. It was on extension from July 15th. It's going to be due October 15th. Let me grab at all those expenses. That's really worth my while. It might save me $5,000 or $8,000 or $10,000 in taxes. An individual TTS trader deducts business expenses, startup costs going back from inception, home office expenses on Schedule C, profit or loss from business sole proprietorship. Now, traders don't have revenue on Schedule C. They report the trading gains and losses on other tax forms. The Schedule C expenses are above the line from gross income. They reduce self-employment tax. So if you have another Schedule C business that generates self-employment tax, this will reduce your self-employment income to reduce that self-employment tax. Trading income is not SEI, but trading expenses are negative SEI. Adding this to your tax return is a wonderful thing. It's just getting a whole set of expense deductions after the fact. Remember, if you're an investor, you only get investment interest expense, and we make a case for stock borrow fees. That's it. And if you take a standard deduction, you don't even get that. Now, there's no election or filing needed for TTS. You put the bread in the oven, you pull the bread out of the oven at year end, it's bread, you claim these benefits. You graduated undergraduate school. You base it on your facts and circumstances. You're assessing it now for last year, for this year to date, for your plans going forward this year, and then you'll assess it again at year end. And that's when you'll see if you can work with us for tax compliance, because we only accept new clients that have trader tax status or prop trader or investment manager status. So you're going to look at after the fact, formalize it, and claim it. What are your business expenses? The home office. Could be a $10,000, $15,000, $20,000 deduction. Depends on how expensive your home is. How big the home office is. Is it 10% of your home, 15, 20%, 5%? Education, you went to that trading school. We're trying to get you to be able to deduct it, to capitalize, to go back 6 months before inception and capitalize it, write off up to $5,000 the first year, the rest over 15 years straight line. Organization expenses, setting up your LLC or entity, your margin interest without investment income as a Schedule C business deduction, your tangible property expense, all those new computers and monitors under $2,500, bingo, direct expense. If it was over 179, 100% depreciation or bonus depreciation, writing off that ATS, all that software, the TCS, writing off all the software, the charting software you've gotten, the self-automated automated trading system, writing it off, the chat rooms, the mentors, seminars, market data, charting services, stock borrow fees, accountants, lawyers, you name it, bingo, it's a business deduction above the line. Don't have TTS, you don't deduct any of it. Now, you got the sole proprietor, the biggest deduction up front, that business expense. There are 4 benefits of TTS. Business expenses, we just did it. Next is 475, the tax loss insurance, the QBI deduction. You can elect that. And then the health insurance and retirement. Those are the 4 benefits. Let's talk about 475. It's a wonderful benefit for securities traders. It gets them out of the wash sales. It gets them out of the capital loss limitation. It's fire insurance on your trading house, tax loss insurance, so you're not disenfranchised from your losses. And if you make income with the new tax law, you can get a 20% QBI deduction. Make 100, write off 20. So there's always been the tax loss insurance. This year accelerated with the NOL carryback. You lose a lot, you do an NOL carryback. And also the QBI deduction new with the tax law. It's the best of both worlds. 475 is securities traders want it, not futures traders. You want to retain your lower 60-40 rates. You want to segregate your investments to have your cake and eat it too, to still keep your long-term deferral on investments for your long-term capital gains rates. So 475 is a fantastic benefit for securities traders, but you missed the boat as an individual. I said sole proprietor is great for the past, and a lot of times it's great for the future. If you worked with us before July 15th, I would have said, you got the TTS starting in April, starting May, starting January. Hey, you should elect 475. You don't have any capital loss baggage. We can get you into 475 now with ordinary gain or loss treatment, but the deadline was July 15th. You missed the boat as an individual. That's okay. You can set up a partnership or S Corp now that elects 475 internally within 75 days of inception. You may want the LLC partnership for ring fencing your trading to be better on TTS, to get the 475, to separate problems with trading as an individual, or you need the S Corp to deduct health insurance or retirement because you left your job, you're not going on COBRA, and you want the high health insurance deduction, and you want the retirement plan for you and your spouse. So you need the S Corp with a new 475 election. So that's okay that you missed the election as an individual. We can do it now as an entity. So see if 475 is good for you, and if it is, we can do it with an entity. It might be great that you didn't do it as an individual, so you could soak up your capital loss carryovers from last year, or your capital losses in January with capital gains since early March, get a clean slate, and now set up the entity with the TTS 475 and all the other benefits. I'm going to be setting up a lot of entities over the coming weeks because it's a great time of year after this individual period and chance to elect 475 to do it all in an entity going forward. But we got to act soon because if we set up the entity come late October, the window of opportunity closes and it's too short a period to impress the IRS and too much expense versus less benefit for the shorter period of the year. So now's the time to think about the entity. And that's what I just said. So you didn't have 475 year to date. You did have some nice gains. You're going to make, you figure, another 50 through year end. Why not line up this $20,000, excuse me, 20% of 50,000, $10,000 deduction through the end of the year? The Tax Cuts and Jobs Act said 475 income is QBI. If you have QBI, there's a 20% deduction on the line. There's all sorts of haircuts. Trading is a service business, so if you make over the haircut, the threshold, you're priced out of it. That's $163,500 for single, other taxpayers, $326,000 taxable income for married. You're single. Your wages were 50. Your trading income is 100,000. You have a standard deduction. You're under the $163,000. Your trading expenses, you're under, so you get the deduction. Your taxable income is higher than your QBI. Your QBI is 100. You get a $20,000 deduction. Why wouldn't you want to set up an entity for the rest of this year to get that 20,000 deduction on that 100K? You missed the boat on the 475 year to date. Go for the gusto. Now, why would you want the LLC S Corp? Well, you want to deduct health insurance. You left your job last year. You were on COBRA for a while. COBRA's expensive. You've gone off COBRA. You want private health insurance, save some money, and get a deduction because COBRA's not deductible. So you set up a single member LLC or a spousal member LLC, and you make an S Corp election within 75 days of inception. And it's just the two spouses. They both are U.S. residents. Can't have a non-resident owner. You can also convey interest to your trust. So you get your S Corp going. The S Corp makes the 475 election within 75 days of inception. And you write off your health insurance. You put that on the W-2 at year end. There's no offsetting payroll tax. Now, if your spouse happens to have health insurance in their Schedule C or job, then maybe, and you already did a 401k year to date max in your job, you might not need the S Corp this year. So when you come to me, if you don't need the retirement this year, you don't need the health insurance this year, maybe we'll do a spousal LLC partnership, or maybe we'll continue as a sole proprietor, and I'll show you how to avoid wash sales for the remainder of the year. This is not for everybody. It's customized advice. But if you need the health insurance and you want the retirement plan deduction and you want the ring fencing, you're going to want to go for the LLC S Corp. And you want to make sure that it works well in your jurisdiction, not in New York City. It's a small tax in California, but a way to work around the tax if you're committed to the retirement. So it's also based on what state you're in, where you are. You want to consult with me about it, read our content about it. So now you did the health insurance on your W-2. Again, remember, this is just a quickie. You go back and you look at that how to set up the trading business webinar from last month for the full deep dive on the S Corp and the health insurance and all that and all the setup. This is just the quick version. So you remember the S Corp creates the salary, which creates the earned income. So you can do the solo 401k contribution plan. You pay some payroll tax, which is good. You're paying into your Social Security benefits when you retire, and your income tax savings is far exceeding that, so you're putting money in your pocket net. And then you're going to do all this at year end when you see you're setting up now. Then you work with our Adam Manning in December. Hey, Adam, I'm up 100. Let's do the payroll of 70 and do the elective deferral of 26K plus 25% of the remainder, but not go into a loss. Well, we can max out. We figure that out in December with Adam. Going for the elective deferral first, that's where the main tax juice is, up to 26K. If you're over age 50, you can do Roth or traditional. And if you want to go greater, then you beef up the wages even more to do the profit sharing plan up to 37.5. So this is all in your hands, all weighted to year end. How much money do you make? How much do you want to put in a retirement plan? How much is it going to save you on income tax versus payroll tax? Bingo, bam, boom. You decide all in December working with Adam, and it is what it is. Otherwise, you don't have to have any of it. It's all under your control. There's no reasonable compensation required. Now, you might also, if you don't need health insurance and you don't need retirement, you might want an LLC partnership with your spouse. Remember, the single member LLC can be disregarded, which is a tax nothing, or the S Corp, but the spousal member can be the partnership. Why do that? You want a ring fence. You got your FANG stocks invested, your MAGA, whatever the symbols are of the day, your big tech, your momentum stocks. That's your buy and hold. You may want to, you don't want to sell that. You don't want to pay taxes on huge capital gains. You're managing risk on and risk off with options. You don't want to do naked options trading. You want it all in the same account. Well, maybe 475 is not for you because 475 could drag those investments into MTM. It's better to ring fence your trading in an entity separate from your investments, separate from your IRAs, so you don't have any overlap and the IRS can't play havoc with you. And you absolutely need ring fencing. It looks better on TTS, and you absolutely want 475 for that QBI deduction and the tax loss insurance in the partnership. So we go with the LLC partnership this year. And next year, if you need the health insurance and retirement, we make the 475 election on that LLC. So those are the benefits that you get from the TTS. So remember, so after this now, you're going to come back to our website and you're going to, let's come to the website, and you'll go to the contact us. You go to the tax center, there's trader tax status. You'll get the guide, which is further deep dive on trader tax status. You'll go back to some of these prior recordings, one for the Money Show, a quick version of how to set up, the one for IB, Trade Station. You'll see different webinars, all similar content. And then consider having a consultation with me to tie it all together. If you do the education, when you have the consultation with me and you get a good handle of what your numbers are, in that 45-minute session, we can figure it all out. And I can write up a whole memo on what you should do. We could figure out the entire tax game plan for you. TTS, yes or no. ATS, yes or no. 475, yes or no. Entity, what type? Do we need it in your jurisdiction? What's the benefit this year, next year, the cost? We'll figure it all out. So you'll do a consultation with me. And usually can get on my calendar within 1 week. I am very busy now because, as you all know, trading has really proliferated. A lot of people are active with zero, low commissions, with great services, with great momentum in the markets. So thank you all for coming today. And let's get to your questions.